Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll put some comments on it. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities. I also share my investment journey and what I've learned along the way investing. There is a discount coupon code that is active, Mayday, Mayday, it's one word. You get 50% off the first month, or you can switch to a yearly membership. Whether you're a member right now or not, you can go directly into the yearly membership or transfer into it at a discount using that coupon code. All right, so we're starting with Ian Castle here. He says, you can't say, I'm going to hold this stock for 5, 10, or 20 years. The truth is, 1, 2 out of 10 stocks you own will deserve to be held 5+ years. And you have no idea which ones they are today, even though you think you do. Those 1, 2 sustainable winners will evolve in ways you could have never predicted. The others will have much shorter shelf lives and not live up to your expectations. This means selling plays a much bigger role than most want to admit. Stock picking means picking winners, but also picking out the losers in your portfolio and replacing them. Long term is an intention, not an absolute. Your intention is to hold as long as management executes. It could be 3 months or 30 years. Most companies will only deserve to be rented. Ownership is earned. Long term is not an excuse to be lazy. Long term doesn't mean inactive. You will be very active. I don't know if I believe with what this guy just said, because every single stock that I'll tell you the shortfall that I have. My shortfall when I was an original investor is that I didn't hold on long enough. And I held on for the period of time that he basically has described here. I would have been better off in almost every single instance to hold longer. I would have been better off buying stocks in 2004, 5, 6, which I did, and I purchased them using the criteria of things that I saw growing. Like I just saw them and I used their products. MasterCard, Visa, United Health Group, Chipotle. Even right now, I would choose In-N-Out, Chick-fil-A. They would be just absolute killers if they were publicly traded. And I would hold them with the mindset of holding them for 20 or 30+ years. And I would make so much more money than what I actually did looking backwards. I sold too early. I did not hold long enough. I chose the winners. And the only way that I chose those companies is because I saw that they were out there and people had them and they were using those products. I saw United Health Group. They're headquartered in Minneapolis. A lot of people had United Health Group insurance. The other big one back then was Blue Cross Blue Shield, which was WellPoint at the time. The company was WellPoint. Now I think it's Elevance. Chipotle. I had Chipotle when I was in I was in California when I first had it. And I was like, dude, this place is going to blow up. It started in Denver, but I had it in California. And right when it went public, I purchased it. I didn't hold long enough. So if I had held, and some of those companies I held in a 401k, which were bought out by a company, and then I had they forcefully liquidated my entire portfolio and moved it into their stupid 401k program. If I had held on to those stocks and actually quit my job and prioritized those stocks, I would be richer today than the money I made at my 9 to 5. Like that's how big those companies went up. And all I did was I just looked out in the world and I said, what am I using? And if you can get this guy, me, to use it, more than likely everyone's going to use it. So MasterCard and Visa, I had credit cards. Obviously, I had a bank account. You could go into the banks. There were certain products, some fast foods that I used to eat back then. I don't really eat them much anymore. And then you look, and this is Chipotle. So this is Chipotle. I had purchased it down in this area here when they first went public. And the total return here from this purchase price to where we are today is 54, 55 times your money. 55 times your money. And I put a good chunk in there. I put 20 grand in total that I accumulated in that area there. So if I had 20 grand times 55, I'd have $1.1 million from $20,000 in that single position. And that was 20 grand across all the accounts that I had. So that was my 401k and also in my individual account that I was trying to build up at that time. And I was 25, 26, 27 years old at this exact moment in that circle. We had a big move. We had the bust in 2008, and then we had a big, huge run. This big flag pattern was the E. coli scare. And then we went up from there. And it's been flagging and flagging the entire time. A little bit more bearish recently, but for the most part, it's been flagging. United Health Group was another one that I had, and I purchased it in the bottom of 2009. I bought it in here. And that was a move all the way up. It's about 27 times my money. And I had that in my 401k that I got forcefully sold out. I also had MasterCard. MasterCard was back in, I think I got it in like 09 or 2010, somewhere in this range here. That's been a huge, 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 huge winner. Another 29 times my money. Visa went public, and I purchased Visa in 2009, right when they went public in here. And that's another one that's done incredibly well. And I had sold some of these out. That's 23x. And I was forcefully sold out in this period over here. I was forcefully sold out because they liquidated. What happened was my company got sold to a larger company. When we merged, they had a different 401k plan, and they moved all those 401k plans, which didn't have brokerage accounts. You couldn't buy individual companies in the brokerage account. So I was just like, I was very unhappy about that. But I had all of the good ones. I had Google back then, 2000. It was Google. I don't know. I was all the way back there. I had that as well. I had Baidu. Baidu is the the Google of China. So China's Google. That was another one I purchased back in this like area there. And I had a whole bunch that were just absolute killers of companies there. And I would say if you choose companies that control the selling price and you choose these big companies that are just dominating, I would look at it from a long-term perspective hold. I tried to focus my buying on companies that had products that never really changed. Like insurance doesn't change, food related products doesn't change. MasterCard and Visa were things that people were using and adopting in ever greater amounts, and they're inflation adjusted, so to speak, because if people experience inflation, they just charge more to their credit card and they collect the fee. The banks own the debt. The credit cards are the ones that collect transaction fees. So I don't know if I agree with what he's saying here. Um, a lot of those companies that I had purchased in that portfolio were insanely good. In fact, I own Hanson Natural, which is now Monster Energy. That was also another one that was there from 2009. That was in this. Oh my God. I don't even like looking at this, guys. And that's another 23 times my money if I had held it. Now there are companies that I made 23 times my money from 2020. From here, I've made 23 times my money, or 30 times my money, or 15 times my money in this period here in commodity stocks off the bottom. So that's what I'm looking at, and I didn't think it was that hard to choose the companies. I thought it was pretty dang easy. And if something were to go public like Chick-fil-A or In-N-Out, they're gonna kill it. I mean, just go around those areas and just see the traffic. Chick-fil-A, In-N-Out, Chipotle is pretty big. The ones that don't have the traffic anymore, like Burger King's kind of pretty weak, and Wendy's is pretty weak. That's what I'll say and what I observe. And then you just go with what you observe. All right, so coming on down, we've got my partner used to work in political risk. One of the things her company monitored was increased food costs. Since this was a leading indicator of civil unrest and instability, it's quite simple. If food costs go up 35%, the best case scenario is that you lose an election. And household food costs increased 35% since 2020. I think it's gone up more than that. I can tell you eggs have gone up a lot, probably more than 35%. I don't know about ribeye steak. That's probably up 50%, would be my guess from what I've experienced, 35 to 50%, somewhere in there. Um, and I would say eggs, beef, um, I cook with butter, but I don't really eat much else. I would say the pistachios and nuts, pecans and walnuts and all that stuff, they've gone way up, way up. They've probably gone up almost double, 50 to 100%, somewhere in that range. So everything that I eat, I would say has gone up more than 35%. I mean, at a minimum 35%, but I would say it's more than that for my own particular inflation. Here's evidence as the average American household spends $270 a week on groceries. And I was just looking at the grocery bill in terms of the highest spending areas and the lowest spending areas. So the lowest is Iowa, Wisconsin, Nebraska. Looks like West Virginia is pretty low, and Indiana. So those are kind of the lowest ones. Colorado, that's where I live, 280. Looks like Nevada and California are more expensive. But the difference or the delta between the average and the most expensive, the average is 270. It's $25 a week. That's not a huge deal. So I would say for the most part, it's pretty even across the board of the United States. Alaska, it has 329 and Hawaii's 334, probably because they have to truck everything or fly everything over there. But I don't know. I just thought this was interesting. Wanted to share it. And for $20 a week, if it's $80 a month, that's not a huge difference. So you're talking maybe $800 to $1,000 a year from the most expensive to the average. And yeah, I mean that it makes a difference. There's a bigger difference in insurance costs and a bigger difference in property taxes. Property taxes are monumental, and state taxes. So Nevada, which has a higher food cost of 295, they've got really low property taxes, much like Colorado does, but they also have no state income tax. And I keep looking at Nevada like, man, maybe I should get my butt out there and start looking at homes and researching areas to potentially live. I haven't been to the northern portion of Nevada. I've only been to the southern portion by Vegas, which I'm not a fan of. It's too dang hot. But Reno and up in that area, Salt Lake City, Utah, and that just east of that could be a good spot to look at, is what I'll say. Or yeah, it's just west of Salt Lake, I should say. Salt Lake's in Utah. But yeah, there's big savings there in terms of state income tax, and on top of it, the property taxes and insurance rates, home insurance rates. So you can look at certain areas in the nation where they're cheap in one category, but they just blow out in another category. So, for instance, home insurance, depending on where you're at in Florida, can be absolutely abysmal. I mean, just massive insurances there. Property taxes in Texas are pretty high. And then you've got the whole hurricane area that's got, expensive insurance. Some of them have very expensive property taxes. And I'm trying to find the mid ground of cost of living If I could get no state income tax, that would be huge. And if I can get good weather that is sunny all the time. And Nevada's the one that pops up. Sunny, decent weather if you're at high elevations. They've got low property taxes, low home insurance, and they've got no state income tax. That's like a big ding, 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 ding for me. All right, Markets Mayhem. He says, we just experienced the largest outflow from tech over the last 4 weeks ever. This is part of the broader rotation we're seeing to other parts of the S&P 500. Under Trump, older economy stocks are more likely to outperform, like energy, industrials, mining, and materials. I don't know how true this is. Um, I really don't know how true this is that he's saying here. I mean, yeah, I see the outflows here, but is that really the truth there? Under Trump, are the older economy stocks going to outperform? To me, and the way that I'm looking at crypto here, crypto broke out to the upside. That looks like it's got some room to run. Now, that just because I don't like crypto doesn't mean that I can't read the charts and maintain a neutral position based off of the positioning of money. But crypto looks like it wants to run to the upside. And if crypto's running to the upside, I think technology is going to continue to go up under that, that same, I think it's the same trade. Quote of the day, it says, a bull market is when you check the prices of your stocks every day to see how much money you've made. A bear market is when you don't bother to look anymore. This says John Hammerslow. There are times where I do not want to log into my account because of a down day or two, and some of those can be quite volatile. So I don't want to look at it. I don't want to get an emotional response. Number two, the transcript says Druckenmiller. The question with AI now that I'm wrestling with, and the reason our exposure is really neither long nor short, is how do you play it? I think it's playing it through energy consumption. AI is a huge energy consumption in terms of electricity. So why not play it with, um, you know, not really not the utilities, because some of those utilities have gone up a lot, but I'd play it with uranium. I'd play it with natural gas. I'd play it with coal, perhaps, around the world. That's how I view it. And all of those are just breaking out. Coal's just breaking out. A lot of the equities there. Energy service is down. I could say that. Natural gas is still down, but I think they're gonna turn up here. I think soon. Nomi Prinz ups her target on gold. She's got $4,000 gold 2025, 5,026, and in the future $9,000 per ounce. She's got silver $50 in 2025, and in the future 100 to 150 is what she's expecting for gold and silver. I would say 9,000 is probably a pretty good number. I'd say 8 to 10 grand, so 9,000 splits me. And my guess in silver is I think it's going to go higher than 100 or 150. I think she's low on silver, but probably pretty close to what I think gold will do. Markets and mayhem. What a run it's been. U.S. financial assets are back to trading at 6.3x GDP, just as they were in late 2021, before the market slipped as the Fed hiked. The backdrop is quite a bit different this time, however. So this is inflation, inequality, immigration, 2020's tough decade for political incumbents. And this is U.S. private sector financial assets as a percent of GDP. And everything is run into financial assets. That started right before, in the early 80s, when we got a bottom in interest rates. Or I should say, a peak in interest rates, a bottom in the stock market. And ever since then, it's been an upward move in financial assets. I think this is going to double top out and eventually roll down, and hard assets will outperform for a period of time. Much like 1940s coming back down all the way till 1980. That's what I think will come. Money wisdom: know what you own and know why you own it. That's to give you confidence to hold it. If you're in these insanely volatile companies, you better know what you own. Otherwise, you're just going to sell out if you don't believe in it. And I'd imagine that a lot of people sell out. They can't handle the volatility. HFI research, it says it's literally in the chart. Per foot productivity has peaked. Instead of posting other people's analysis, write your own. So 2024 is best US shale productivity ever. So, to the surprise of many, 2024 unconventional wells are on track to be the best wells ever drilled since the beginning of the US shale industry. Longer laterals, high grading, and wider spacing have all played a part. And that is per well performance is up 16% since 2023. Well, you know, the tough part here is that drilling is they're doing these super long horizontals. They're drilling like for miles, 3 miles, 4 miles, maybe even gets to 5 miles eventually. I don't know. So on a per well performance, if you're drilling longer, of course productivity is going to go up because you're drilling a longer horizontal. But on a per foot productivity, you can see we're trending up, but it's not as big of a difference. So we're up a little bit, but it's not as up as much as a per well performance because they're doing longer horizontals. Investment wisdom says seize any opportunity or anything that looks like an opportunity. They are rare, much rarer than you think, says Nassim Taleb. Coming on down, observable oil inventories. Here we are at the lowest it's been in the past 1, 2, 3, 4, 5, 6, 7 years. We're the years. So if our inventories are the lowest, shouldn't we be at the highest price given the past 7 years? And that's definitely not the case. So I think there's value in oil given where oil is priced against gold and where our global observable oil inventories are at. I think it's a huge setup. My opinion. Kevin Beebe says, keep seeing so-called smart people arguing against Trump's tariff plan. But that's only because they think in checkers, not chess. And yes, Trump's plan is an epitome of 5D chess. Here's why. So replacing income taxes with tariffs is a seismic shift, and this idea isn't for the faint of heart of those clinging to the current tax system's worn-out model. Imagine no income taxes deducted from your paycheck. You get to keep what you earn. Dude, that would be huge. If I didn't have to pay income taxes, that would be huge. That's right, no federal tax holding you back. For many middle and lower income Americans, this could mean a significant boost in take home pay. I disagree with that. They don't pay any taxes. The majority of middle and lower income American families pay zero federal income tax. Zero. Instead of funding the IRS's tax collection machine and being trapped by a bureaucratic income tax code designed to squeeze every last dollar out of you, your tax contributions would be automatically folded into the cost of imported goods. I'm fine with that. If that's the case, I'm okay with that. Now let's look at the tariffs as the new tax framework. This plan means the US would replace income tax with taxes on imported goods. Let's break it down. Tariffs raise the price of imported items, pushing Americans toward domestic alternatives. By making imported products more expensive, American-made goods would have a fighting chance to reclaim the market share they've been losing for decades. This isn't just a patriotic pitch. It's an economic boost to American industries that have been undercut by cheaper imports for years. Tariffs encourage consumers to buy products made in the US, workers in US factories, which translate into stronger demand, more jobs, and even potentially higher wages in manufacturing and other critical sectors. The goal is to bring production home and boost employment, not only in manufacturing, but in every industry linked to it, from raw materials to logistics. Of course, tariffs on imports mean higher prices on some goods. And that's the big, I'm not going to read through all this because he's got a whole bunch there. But I would be for it because then I have a choice. If what I bring home, I can choose to buy something or I can choose to invest my money. I don't spend a ton on buying frivolous. So it would benefit me hugely if I didn't have to pay federal income tax. I mean, that would be huge. I would love that. Love, 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 love that. There's Grady. Silver resumed its secular bull in Q1 2024. And gold in Q4 2023. Link posts below are one of the many of the breakouts. Whatever you do not mess up this life-changing generational opportunity. You will have one chance at it and only one chance. And here is the potential. We've got the breakout in gold and then the potential huge percent move in the third bull move, which will kill the present global monetary system. And that's why he thinks you only have one chance, because the global monetary system will collapse, in his opinion, and gold's going to do some ridiculous move. Silver's going to follow too. And these guys are going to reprice each other. I think they're probably going to get repriced against everything in the world. And we could see bond markets and currencies have problems. And I would say he's probably right. Here's another one. So, President of European Union Commission says they want to start buying oil from the United States and not Russia. Trump wins the election and the world falls in line. It's remarkable. We still get a lot of liquefied natural gas from Russia, and why not replace it by American LNG, which is cheaper for us and brings down our energy prices, said Ursula von der Leyen. But it's something where we can get into discussion also what our trade deficit is concerned. So maybe they start buying more American produced energy. The big daddy macro charts you should keep an eye on. And again, this is the 140 years of U.S. stock priced in gold. We've got the rounded topping structure on the right-hand side that's about to roll on over in favor of gold, where every single time it's done that, we've had a commodities bull market. And we are doing that and rounding over that top right now. Jordan Roy says 3 times gold broke to new all-time highs. In each case, the first correction after the initial breakout move tested the 200-day moving average or the 150-day moving average. After those 3 tests, gold gained in 15 months, 400% in 14 months, and 51% in 15 months. Following the weakest could put gold at $3,700 to $3,800 an ounce in Q1 of 2026 if it is the weakest of those moves. So we could go way higher if it's a 400% move. I mean, way up there. And that's where we're going to end it, guys. So that's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later.